Hello, my name's Ethan Wrenn. Make sure to check out my website, ethanwrenn.com. From there you can find links to all my various socials. We are currently live on Twitch, YouTube, and the front page of my website, so make sure to follow or subscribe if you'd like to get notified when we go live next. Today, we are looking at a video from the official TD Ameritrade YouTube account, and it's called Forex Strategies, the Carry Trade. Let's learn more about the carry trade.
Popular Forex trading strategies is the carry trade. This strategy capitalizes on the difference in interest rates among countries. Interest rates differ from country to country. This means you may be able to borrow money at a low rate in one country and invest in a country with a higher interest rate. In this video, you'll learn how a carry trade is constructed, how these trades can earn interest, and what risks are associated with this type of trade. Let's start with interest rates. There are many factors that influence interest rates, such as economic growth and inflation. These factors can change depending on a country's monetary policy. Monetary policy is when a country's central bank manipulates short-term interest rates to help promote economic growth, maximize employment, and maintain steady consumer prices. For example, if Japan's central bank is trying to stimulate the economy, it will reduce interest rates to encourage borrowing and spending. At the same time, the Bank of Canada may be concerned about rising inflation. To combat inflation, Canada's central bank may choose to raise interest rates. This will encourage people to spend less and invest or save more. So how does this work? Let's run through a simplified example to illustrate the concept. Suppose a trader borrows money from Japan for 1% and invests in Canada for 3%. If a trader bought the Canada-Japan currency pair, he is long the Canadian dollar and short the Japanese yen. Basically, the trader is borrowing money from Japan and investing it in Canada, which creates a carry trade. The carry trade in this example resulted in the trader earning 2% interest. Each day, the trader will receive the interest earned, and it will be added to whatever profit or loss the trader experienced from the currency pair's change in price. The carry trade is one reason interest rates are so important in the Forex market. When a divergence of interest...
I feel like this is a great video to go over because we hear so much about interest rates, and Forex can be a relatively daunting topic for newer novice investors. But when you hear it explained so clearly as they're doing here, it really does help people understand how it is these currencies gain and lose value.
Rates occurs, billions of dollars are commonly redirected to capitalize on it. This influx of investment will commonly...
One of the most important things to take away from interest rates is it's not a matter of what the interest rate is. It's more important about what the interest rate is relative to its peers or other nations. And you typically tend to see an outflow of money from countries that have low interest rates and inflow of money into countries that have high interest rates.
Drive up the value of the long currency and drive down the value of the short currency. In our example, this means we would expect the Canadian dollar to rise in value against the Japanese yen. However, there's no guarantee that a currency pair will appreciate. For example, if a policy change was enacted and the Bank of Japan pushed interest rates higher, the pair would probably depreciate. Even if the divergence in interest rates remains significantly high, the interest gained could be offset or even overwhelmed by price depreciation. Consequently,
and that's another important factor of this. When it comes to Forex, as they were just quoting, people are looking to capitalize on potentially small percentage moves in these currencies, right? Well, if you're looking to potentially gain 1 to 2% on a carry trade by borrowing money in one country and another, you need to be very conscious of the potential fluctuations in those currencies for reasons other than the interest rates, whatever it may be, whether it be economic growth, whether it be inflation, etc. Because if you're only looking to potentially capitalize on a 2% gain caused by a differential in interest rates, and a geopolitical event happens that causes the currency you invested in to dip 3%, regardless of what the interest rates are, you're now negative on that trade. So ideally, in a perfect scenario, you'd be seeking to gain on both the differential in the interest rate, but also simultaneously an appreciation of the currency for the country you're investing in.
Many traders only focus on carry trades when the price trend is in their favor. The expectation is that this will reduce the chances of the price moving against them, canceling the benefits of interest payments. Adding to the complexity, some currency pairs must be shorted in order to collect the interest payment. If the European Central Bank was paying 1% and the U.S. Treasury was paying 3.5%, you would have to short the European-U.S. pair to collect interest. It's also important to realize that when trading a currency pair, you may be required to pay interest. For example, suppose our trader wants to trade an upward trending pair. To do this, he'll have to cut into his profits because he'll be required to pay interest. Traders should check with their dealers to clarify which accounts are available to collect interest. Understanding the influence of interest rates on currency pairs can help you determine which pair to trade and how to potentially increase returns by collecting interest.
And I think that video did a great job of explaining a relatively complex topic. And again, if you guys are new here, make sure to check out my Discord. You can join the Discord by going to my website. It's completely free. You have access to a lot of great resources that can help you better your trading. As you can see here, we have this Discord stock bot, which you can use to generate charts and share information about potential trade ideas that you might be looking into.